according to Canon asset managers, the rising valuation dispersions across the JSE point to a massive investment bubble in certain areas. Canon advises steering clear of these investment risks, despite many of them being large, well-managed and well-known companies. And despite the scary scenario, Canon believes that there are still opportunities for investors to profit. Andrew Dittberner from Canon joins us in studio to explain how. Warren, before we begin, over to you.
Thanks, Bronwyn. We obviously just wanted to get into this, when people use the word investment bubbles and the fact that there's substantial risk, we wanted to just talk to that a little bit. And in Canon's press release, just outlining some of these points, they used some graphs which I thought were appropriate to bring into the show today. The first thing we need to just confront is something called the cyclically adjusted price earnings ratio. And that's just a valuation metric or tool that's used by many value managers just to get a sense of where companies are relative to a cycle. So if you use the CAPE ratio, for instance, it would have stopped you from buying construction companies at the top of the peak in 2007, 2008, even though things were looking so good, because at that point, if you look back 7 years, they were expensive by a cyclically adjusted ratio. So just to give you a little intro into what's been going on here, Canon divided the JSE up into five segments, each with 20 shares. And they said, well, what's the difference between the most expensive shares, which are in the top quintile, and the least expensive shares? And this line over here just shows you where the difference, how much the difference has moved. You can see it was 12.8% back in December 2008. It's now 18.4 times is the difference between the two. And just in the corner, you can see some of the graphics, and we'll allude to that more in the slides that follow. But some of the very well-known companies that people are comfortable investing, naturally comfortable investing in, are looking very expensive. And if we go to the next slide, we'll actually see just some of the companies we're talking about here. You can see in the red chart, the investment risk, those are the companies that are looking very overvalued. And you've got some big names in there like SAB Miller, Richemont, and Truworths. And then over here, perhaps what Canon believe are the real cheapest stocks, which you could call Group 5, Avenge, Lewis, and even Anglo-American. If we just go to the last slide now, we'll actually see just the difference, again, the difference between the two. And then we'll get into some of the names now with Andrew around who are looking the most expensive. But I think, Bronwyn, the first question we want to ask Andrew is, first of all, what's the definition of a bubble?
Yeah, exactly. And does a bubble mean that ultimately it's going to burst?
Yeah, that's a very good question. I don't know if there's a definition of exactly what is a bubble. But I think what you can see is when you look at this market, there's certain parts of or pockets of the market that are looking exceptionally expensive. And I think when you're trading on a through the cycle PE ratio or your cyclically adjusted PE ratio, when it's getting in excess of 30 times, that's beginning to look very, very pricey. Trading on demanding multiples like that, we'll say that you probably want to stay away, and that's where your investment risk is. They're great companies, and you obviously want to invest in great companies, but the most important thing is what's the price that you pay for that business. So I think, is the market in a bubble? Definitely not. I think the market's probably fairly valued, but there's certain pockets within the market that are looking bubblish, if that's the word.
Andrew, we've seen that obviously that gap between the most expensive stocks and the least expensive stocks has actually widened. I'm just interested to find out why that's the case.
Yeah, we obviously do a lot of work to try and understand what's driving the market, what shares are performing, and which parts of the market aren't performing. And it guides our investment decisions, and it also guides us on why we might be outperforming or underperforming. So what we've seen probably over the last, since I suppose the global financial crisis in 2008, what we've seen is that value shares have underperformed, and the expensive parts of the market, which are your retailers, there's been obviously a lot of noise about that over the past year. Your large cap industrial companies, they've been driving the markets. These are companies that are fantastic businesses that derive revenue streams from not just South Africa but abroad, and they're good dividend payers, and you're in a low interest rate environment. Foreigners are looking for that yield. So these shares have been getting more and more expensive. So when you break the market up into your 5 quintiles, you see quintile 5 or quintile 1, whichever way you look at it, being the 20% most expensive shares, they've been getting more and more expensive, whilst your value shares in the bottom quintile have been getting cheaper.
Do you stick to your traditional valuation analysis here, or have the retailers, the industrials, really formed a new environment that maybe we need to measure them differently?
I don't think we need to measure them differently. I think you can look back at history. I know history doesn't always repeat, but it definitely rhymes. And people say this time's different. I don't think this time is different. You can't forecast. Well, we believe you can't forecast. Others might believe they can. But when you're looking at the earnings through the cycle, they had great earnings last year. They need to produce exceptional earnings this year, or earnings growth, to justify the multiples that they're on. I don't think we need to look at different valuation techniques.
Okay, case in point, Capitec. Look at their results out yesterday. Sterling set of results. The share price closed up on the day. They appear to be maintaining the momentum. And wouldn't they fall into one of the stocks that you are saying right now is overvalued?
Yeah, I think Capitec's probably a special case. And I wouldn't really want to look at through the cycle PE ratio to try and value that business. It's growing incredibly quickly. You would expect it to have quite a rich CAPE ratio. We would probably look at a price to book, and at a price to book, I think it's at a price to book of about three times now, and with an ROE of 25%, it can justify that sort of price to book. It needs to continue to deliver these good numbers that we saw yesterday. Whether it can do that, all the noise around unsecured lending, it needs to maintain this earnings growth to justify the price to book, and we're not sure that they're going to do that.
That was exactly the question we put to Riaan Stassen.
I think it's such a tough one, Capitec, because I speak to so many managers, and especially value managers like yourselves, and they all regret not buying Capitec, but they all say that it's always been an expensive share. So, do you make an allowance for that in your investment approach, or not? Is there the exception to the rule to include in the portfolio?
No, we definitely don't style drift. We're a deep value manager. We would never go and buy a company based on what the growth expectations are. Hindsight's a wonderful thing. Obviously now looking back, yes, we would have loved to have had Capitec. I think everyone would have loved to have had Capitec over the last 5 years or so. But we saw it in Able probably 5-6 years ago, when Able was trading on price to books of similar magnitudes, 3-4 times, and we know what happened to Able through 2008 and 9.
The biggest risks right now, where do they lie? We've spoken about ShopRite. What are the other? And obviously Warren put the graph up where the CAPE ratio was very high. Is that correct?
Yep.
Yeah.
So just a couple of the others where warning signs, those red flags are going off.
Yeah, where we've seen the biggest investment risk is definitely your large cap industrial companies, as I mentioned earlier. And these are your retailers, your ShopRites, as well as your Richemonts, MTNs, SABs. These companies are looking quite rich. So that's definitely the part of the market that we're avoiding at the moment. If you go and look at what we would call your domestic industrials, or your smaller cap, locally focused industrial companies, and these include the likes of Metes, your Trencals or Grindrods, some construction companies, and your small IT companies. There's great value to be had there. So that's where we're busy looking at the moment.
Just before we move off, SAB Miller, I've discussed it extensively of late with a number of people, and it's been touted as the defensive stock that you need to have in times of turmoil. How does that marry with your thesis?
Yeah, we're not a thematic investor, so we definitely don't go and try and buy defensive shares when we think the market's richly priced. SAB, again,
it's expensive, absolutely, no doubt.
Yeah, a great business, but for a value manager or a true deep value manager, you're definitely not going to be looking at SAB right now.
Andrew, I know it's probably not within your realm of your work or your job, but how do you think this plays out? Why do you think, is it largely foreigners, do you think, that have driven up the prices of these large industrials? And what would be the catalyst for them to stop buying these types of companies? Because they've obviously gone up a heck of a lot.
Yeah.
What creates the change to get these valuations back to a more normal state of mind?
I think I'm not so sure it's foreigners coming into the market. I think it's rather been foreigners switching out of resources, going into industrials. Obviously, resources have had a very bad rap of late, specifically the South African resource companies. So I think it's probably a switch from resources into industrials. What's going to cause them to withdraw their money? I think when we see this monetary easing stopping, you've got a lot of free money out there at the moment in a low interest rate environment. People are looking for yield.
But that's not going to happen anytime soon, Andrew.
No, it's not, and we can't forecast it. We don't know when it's going to happen, but that's definitely not a reason for us to style drift and I'll say, you know, let's go into these retailers. The South African consumer's under pressure at the moment. We all know that. Can these retailers continue producing the earnings numbers? Probably not. Well, we don't think so.
You've made the difference between the top, the most expensive, the top 20% most expensive, and the 20% the cheapest. And,
Yeah.
and we're going to talk a little bit in the second half of the show about some of those stock picks that you've been buying. But how does the market look as a whole for you now at the moment? I mean, you've identified this pocket that could be considered a bubble. Generally, has the market had if we look at a market-weighted index, is it pushing north of expensive?
Yeah, I think the market probably as a whole right now is fairly valued. If you look at a CAPE ratio, and the CAPE ratio, the cyclically adjusted P ratio, has been around for a long time. I think it was Benjamin Graham and David Dodd back in the 1930s that developed this tool. And when they did it, they found that the average, or the long-term average, was about 16 times, which is your equity risk premium, 1 over your equity risk premium, which is about 6%. So it gives you 16 times, and that worked in the US and it works in the South African market at the moment as well. Right now we're sitting at a CAPE ratio of 16, so we bang on what we would call fairly valued, and then looking forward we would expect equity-like returns, which is probably going to be in your low teens, 13, 14, 15%. That's what we're looking for over the next year.
And you're referring specifically to earnings growth there?
Yeah, we're not going to see multiple expansion. We think, well, I mean, you might see multiple expansion, then the market starts to get expensive. What needs to drive the market is we need to see some earnings coming through.
Let's talk a bit about the smaller industrials where you're seeing value. Take something like Grindrod. Now, that has been a story that has been ongoing for some time among the value managers. Grindrod has failed to deliver on that story. Is it just purely a timing thing? This is, we don't try and time the market, but this is a 5, 6, 7, 8 year story if you buy Grindrod now?
Yeah, I think, the world economy is not about to fall apart. Grindrod's had a tough time and people seem to think that trade's not going to continue. Trade is going to continue. Grindrod, I mean, obviously with the shipping rates coming down, there's oversupply of ships in the market. So, I mean, they've had a very tough time over the past few years. I don't think this is going to turn around necessarily this year, but it's definitely a longer term view. We don't hold any Grindrod at the moment. We prefer Trencor, which is a similar sort of business. They're a shipping container business. So it's exactly the same sort of business. And we're looking at a long term view on this, 3 to 5 years.
I think just with Grindrod, I think the model is changing there a little bit. It used to be just shipping containers, but now they're getting into infrastructure. They own, I think, a stake in the port at Maputo.
Yeah.
And they've been, I think, taken a sizable investment by Remgro, if I'm not mistaken. So you say you're not thematic investors, but are you aware of what's going on in the broader picture with regards to companies in South Africa moving into Africa and expanding their footprint? I mean, does
that hold appeal for you effectively?
Yes, I think, I mean, that's a great point. We definitely look for that. I mean, that's where companies, that's an obvious place for South African companies to expand and to grow their earnings. If they're battling to do it here, Africa's a good place. You've got to be careful. A lot of companies, as we all know, have come unstuck. But a lot of the companies that we invest in, ELBs are great examples. A small little, you could call it a construction, it's a plant hire business. Essentially, they're very much involved in Africa at the moment. And you look at some of the construction shares that we hold as well. So that is something we look at. Do we base our decision on that? No, but it's an important component.
Andrew, we're coming back after the break. Stay with us.
Thanks.